Okay.
Now you could start.
I'd like to call the meeting of the Norwalk Pension Board's order and seek approval of the minutes from the last meeting. Anybody have any comments on the minutes? When I reviewed them, they seemed fine. If not, if there's no changes, if there's a motion to accept the minutes.
So moved.
Second. All in
Second.
favor? Aye.
Aye.
Passes unanimous. Is there any public comment? If not, just before we go on to other business, I think that you might have gotten an email, but Joseph Kramer has left the board. That was a result of the policy from his firm. I met with them. I just wanted, for the record, that I was on the board with Joe for over 13 years. I really enjoyed him very much being on it. He was someone who would be direct, ask good questions, and cared a lot about it. So I just wanted to put it on the record that he was a real asset to the board, and it's unfortunate that his firm, because of conflicts of interest, potential conflicts of interest, asked him to resign. And also, he was also really good, that everybody on the board would appreciate, is that he kept me in line to make sure the meetings didn't run past 8 o'clock. So,
Who's going to assume that responsibility now?
well, since you spoke up,
I'll
I guess it's
step up.
gonna.
Not a chance. But
I'll
I do
step
want to go on record as thanking Joe, because I've been on the board with him for that same period of time. He was always here. He was always active. He always spoke up. He was an asset to the board. He will be missed.
Agree. Agreed.
Right. So I appreciate that. Maybe sometime we should get together and have a drink with Joe and toast his 13 years on the board.
Frank, you're burning time.
Oh, yeah, that's right. Yeah, but I don't have Joe to give me a hard time. You know, I told my wife to make dinner around
You're burning
9:30.
time, Frank.
Charlie, I guess there's going to be 2 people replacing Joe.
Good.
Anyways, I think there are no pensions unless that's changed in the last few minutes. So there's no
Frank,
pensions.
this is Jerry. Can you hear me, Frank?
Yes, I can, Jerry.
There are, just to confirm, there are no pension applications to submit at tonight's meeting.
Excellent. Thank you very much.
What's our
Of
policy for over the summer? You know, our next meeting in September.
Yeah, we will not have formal meetings during the months of July and August. Any applications that do come in during those months are the Chief Human Resources Officer has the authority via the pension plan document to approve those applications, and then they will be resubmitted to the board when we convene in September.
Okay, sounds great. Thank you.
We've
Of
also
course.
had a history. If an emergency comes up, we've had an email meeting or a telephone meeting if necessary. Given the state of the world today, I would be prepared for something like that.
Well, we can do Zoom also. We're good at that. Yeah.
Now
Right.
that we have it, exactly.
No, that's a good point, that we don't meet until September. However, under extraordinary circumstances or some kind of an emergency, and if we can get in touch with Brett, then we could have a meeting. So that next would be Blackstone. So I'm going to turn it over to Brett.
Thanks, Frank. So we have Blackstone here, Maya, Pollock, and I believe Steve. So Blackstone's one of the global equity long-short managers in the portfolio. They've been a manager with Norwalk since 2002, so very long relationship. I'm going to turn it over to Blackstone. If you could keep it to about 30 minutes, including questions. Keep an update on the firm, the team, and if we could dive into performance. I know year to date and about the last 18 months has been a little bit challenging, to say the least. And I know the board would be interested in hearing an update on the strategy. So with that, I'll turn over to Maya and Pollock and Steve.
Hi, good evening. Thank you so much for inviting us to present. It's our pleasure. Thank you, Britt, and thank you to the board. I know it's evening, so hopefully everyone has some energy left for the update, and know that performance has been challenged as of late, year to date in the last 12 to 18 months, so we'll make sure to address that. As Britt mentioned, this is a long-standing relationship, and we really appreciate the partnership since 2002, and your investment in our park and T strategy. I'll start with the introduction. So my name is Maya Henry. I'm a member of our Institutional Client Solutions team, which is the name for our client-facing team within BAM, which is a division of Blackstone. I'm joined today by Steve Solens, who is a partner of the firm, senior managing director, and head of portfolio management for BAM. He joined Blackstone and BAM back in 2001. So he was actually involved in the initial conversations with the city of Norwalk back in 2001, 2002 timeframe. So we thought it would be suitable for him to share this update. Steve oversees portfolio management for all of BAM's multi-manager programs, and is responsible for directing the manager research team in the hedge fund manager selection and monitoring. We're also joined by Rob Stockbridge, who is a vice president on the team and is one of the 5 people on our equity strategy team. Within our BPS business, which is Blackstone Portfolio Solutions, which includes our multi-manager commingled funds and custom portfolios, we have 4 different strategy teams, which include equity, credit, global macro, and quant. So Rob is on the equity team. And we're also joined by Palak Munjal, who is an associate on the client-facing team and is helping me with overseeing the relationship. In terms of organizational update and team, I think most relevant to this portfolio, we've recently hired a gentleman named Mitch Golden as a managing director. He joined in April of this year, so just about a month ago, as the new head of the BPS, which, as I mentioned, Blackstone Portfolio Solutions equity team. So Rob reports to Mitch Golden. We thought, since he's just started with the firm and is getting up to speed on the portfolios and managers, we didn't invite him to this call, but in the future, we look forward to have him join and share his ideas. But he's been spending time getting to know the portfolios, the team, and introducing some of his ideas for the equity portfolios. Mitch has over 2 decades of investment experience across asset classes, geographies, and private and public markets. He joined us from most recently as a sole portfolio manager of Greenlight Masters, which is the equity focused fund of hedge funds of David Einhorn's Greenlight Capital. Actually, I should correct myself that he spent over a decade there and had really great track record, but also previously worked at Senator, which is a BAM seed and current manager on our platform. But most recently, after spending a decade at Greenlight, he was the CIO and launched his own firm, Kindle Capital, and brought some of the team with him to Blackstone. So we look forward to his leadership of the equity team and his ideas as well. Hopefully you received a copy of the presentation. In the presentation, and we're happy to share a screen if that's helpful. We included a few pages in terms of just the deck. We included a few pages on the firm, Blackstone and BAM, as well as an executive summary summarizing the performance of your investment, specifically since your inception date in 2002, and then the standard presentation on the park strategy since the fund's inception date in 99. So I would just highlight, before we dive into the performance and the portfolio, I would just highlight in terms of organizational update, Blackstone has had a really strong year in terms of performance and inflows. Obviously, we understand the challenge performance in this strategy, but broadly as a firm, has had a phenomenal year. Assets under management stand at $915 billion as of 3/31. And Palak, maybe you could share screen and go to page, I believe it's page 3. We can start with page 3. You can see here, as I mentioned, 915 billion in total assets under management for the firm. BAM highlighted in green there, with 83 billion under management, and that AUM has been stable and actually increased in 2021 due to strong performance across our strategies. Palak, we can skip to the next page. Here, just very briefly, we have strong alignment of interest. Thought it would be worth highlighting that we have over 2 billion of internal capital invested in BAM, and average tenure of our client relationships is 9 years, and with over 50% of inflows coming from existing LPs. Palak, and next to the next page. And this is just a summary, and for your records, a summary of kind of the products that we offer on the platform. The platform has really evolved over the past 10 years or so, from the traditional hedge fund solutions provider to a broad platform with pretty incredible breadth of different products that span from liquid strategies to partners on top, which is our flagship multi-manager strategy, to equity products such as Park, as well as Horizon strategy, which is a growth equity crossover fund that we launched last year, our special situations platform, the dislocation fund that we launched this year, our emerging manager seeding platform, or SAF, and then our GP stakes business, which is really positioned as a yield enhancement vehicle, where we closed on our Fund 2 last year, 40% above target, and we'll be coming back to market with Fund 3 next year. So this is just briefly on the platform. And then Palak, next page, please. In terms of the team, we did go through a leadership transition. You probably know that Joe Dowling, who's you can see on the top right center page, joined us in the beginning of last year, 2021, so about a year and a half ago, initially as co-head of BAM, and at the end of last year, he became the sole global head of BAM. Joe joined us. He previously ran the Brown University Endowment, which you probably know performed really well in the Ivy League and broader college and university US endowment space. And so he is a proven allocator, and also successfully ran a hedge fund prior to that. And he's brought a lot of fresh thinking and also some new talent to the team. Just some notable hires that we've made. You can see just below in the row, just below Joe Dowling's name, we brought in David Benor, who started in the beginning of last year as the CIO of the BPS complex, as well as Scott Baumer previously to run the Horizon Fund, and Atish Nigam to run our special situations business.
Before you move forward, is there any additional expected turnover or new hires in the next 6 to 12 months? Obviously, there's been a lot of change in the leadership here, and I think a lot of it's explainable and understandable, but any additional team changes anticipated or new hires in the future?
Not that I know of. It's a difficult question to answer because as you probably can imagine, especially at the senior level, the departures and additions are, even if they're in progress, they're kept confidential. So we are confidential for the right reasons before the decisions are finalized. So nothing that's imminent and that I'm aware of, but it's been a strong market in terms of just in finance. And so we've had departures where our people were attracted to new opportunities and were asked to run, and join other firms in exciting roles. But we've also attracted really high quality talent. Paget McCall on the page also joined in July of last year, and she heads the group that I and Palak are in. She was a partner at Goldman, heading North America business for GSAM in terms of investor relations and fundraising. And so she's now global head of institutional client solutions at BAM. And as I mentioned, David Benor, who was the CIO of Cam Capital and ran Bruce Kovner's Caxton Associate Fund, which we were in the position to bring Bruce's assets and are managing now on the Blackstone platform as well. And I mentioned Atish, who came from Appaloosa, an investment firm that's managed by David Tepper, and he was the right-hand man essentially of David. And so I think those are just some examples of some of the really high quality talent that we were able to bring on the platform. I'm not aware of upcoming departures, but those I think can always happen given it's a team of over 300 people with 116 investment professionals. So departures do happen, but I think that we have a really strong and deep bench of talent across the platform and across our areas of business that are relevant to your portfolio, including Mitch Golden, as I mentioned, who we're really excited about him joining.
Maya, this Rich Baskin, I have a question. Is there an overriding theme or goal of the talent that's being brought in? I'm sure Joe Dowling has an overall goal or theme or direction. Can you share that with us, and how some of the talent being brought in is looking to build some new strengths or address some weaknesses that you've seen?
Yeah, so I think, and Steve, also please comment if you have any, if you'd like to add any comments. But I think whenever you have a leadership transition at that level of Joe Dowling, some of the changes to the team are expected. So for example, with David Benner, he's known him for many, many years. It's someone that he respected. And some of the departures were frankly driven by Joe's joining, and some of it was whether, the way that certain people wanted to run things, including some of the predecessors on the equity team, were maybe not aligned with Joe's leadership or vision for the business. And so some of the people, I think some of the most senior people that were brought in over the past year were definitely people that Joe knew in his prior career and respected and worked with, across the industry. David Benner's role was not replacing anyone in particular, but I think Joe felt that he could use someone who is a proven investor and allocator in that role to oversee the PPS complex, which is more than half of the assets on the BAM platform, which includes Partners, our flagship multi-manager strategy park, and about 60 to 70 custom accounts that we run. Scott Baumer, who runs the Horizon, manages the Horizon Fund, is someone he knew going back to business school. They were at Harvard together, and Joe felt that we on the platform were missing a growth equity type of strategy, and so that fund launch was Joe's and Scott's idea and doing, and Scott is someone that he brought on. I think it's somewhat similar story on the special situations team.
That's great, and thank you for your answer. Has Joe, and can you share with us any kind of overall vision or strategy or direction or 5-year plan that that he is pursuing? As we are long-term investors, we have a long-term view, and so we are interested in what Joe's long-term vision is. Can you share anything like that with us?
I think broadly for BAM, and we'll comment more specifically to equities, and I'll let Steve handle some of that, but and Rob as well. But I think broadly for BAM, there's no Joe does not have a goal of changing the mission of delivering superior returns and capital preservation, frankly.
That's a pretty standard answer. I'm looking for something more more specific.
A couple of points I'd make. I think one in particular is, and again, it's not that this wasn't present previously, but I think a real emphasis on integration with the firm and kind of taking advantage of ideas, be they specific investments that we can participate in with our private equity business, our growth equity private equity business, the real estate business, which again, real estate, we've not so specific in the park portfolio, which is an equity portfolio, but in our broader business, you know, our involvement in the housing market in the US, both on the mortgage side and the single family home, something I think, you know, we've done that effectively, but I think Joe's really made a point, as John Gray has as head of the firm, I think, and that's, you know, John brought in Joe, and I think they both have a very consistent view of the importance of leveraging off of the expertise within the firm. And some of the, especially some of the newer legs that have brought in our healthcare business, our growth equity business, which are areas, frankly, that Joe is probably, I mean, he ran the entire endowment at Brown. So it's broad familiarity across asset classes and styles. But I think, you know, as Maya, I think, mentioned, kind of the growth equity space across from the VC through, you know, public markets and you know, those type of hedge funds is something that he knows quite well. And again, that's been an area of development within the firm that historically has been more rooted in more kind of cash flow oriented private equity value. I think that's
Right.
Now, when we talk about performance and what's gone on in the markets the last, you know, 12, 18 months, that's by far the most difficult area. But I think you know, that it also sets us up well for opportunity, and you know, we're using dislocation capital to take advantage of just those types of things that you know, they've highlighted.
I think that's really helpful. But one of the things that you know, the thought that got triggered by me was that some of these things sound a bit less liquid, and you know, we're in a situation, our pension fund's in a situation now, we're paying out more than we're bringing in. And so liquidity is important to us. I mean, as the horizon of some of these investments extended out, you know, beyond 5, 10, 15 years, what do you expect the implication is on liquidity in this direction? Because, you know, quite frankly, you know, Brown doesn't need liquidity. You know, they don't care. You know, Brown University doesn't care. All they're trying to do is to beat Harvard, and Harvard doesn't care about liquidity. We care about liquidity. So are we talking about becoming less liquid as a whole, which is fine?
Yeah.
But
No,
it may not be appropriate for us.
I actually think
that's where I'm trying to understand.
Yeah. And it's a totally fair comment. I think the pendulum is actually swinging back the other way, given what's going on in markets today, right? I mean, part of the reason why, you know, a lot of money moved towards illiquid opportunities is because in liquid markets, you had spreads as tight as they ever been historically. Yields were so low. You know, equity markets were fully valued, you know, certainly on the public side, in kind of unprofitable tech. And so money was drawn into these kind of less liquid opportunities as people search for yield. And I think now you have, you know, look at the biotech healthcare space, you've got liquid parts of the market that are, you know, down 50% over the last, you know, 14 months. And I think when you look at where dislocation exists today, I think it can be, and we'll see the path forward from here, much more oriented towards liquid opportunities, which has not been the case for a period of time. And there's no doubt, even within Park, you know, the fund that you're invested in, you know, managers had the flexibility to do, you know, pre-IPO, almost kind of late stage VC type investing, and those exposures, probably the duration of liquidity there has been extended by the closing down of the IPO market, and you know, companies haven't raised capital, lower valuations. That whole process is there is some illiquidity that exists on a look-through basis in the portfolio, but I actually think the opportunity set is moving back in the direction of more liquid things, given some of the price adjustments we've seen.
All right, thanks for that comment.
I have it's Jim Henderson. A quick question to either Maya or Steve. So you mentioned you want to move more in the direction of leveraging other parts of the firm. What percent of the portfolio has been, and what's the direction in terms of moving that needle in terms of percent of the investments that are sourced throughout the rest of the firm?
I mean, by far the bulk of the business in the bulk of the allocation within these products, and we allocate to managers, right? So the vast majority of what we're doing is allocating through managers. Increasingly over time, though, there has been, co-invest, direct investing taking place. Again, probably to a lesser extent within Park. So I would say the aggregation of single ideas is probably, less than 5% of exposure. But again, there are ideas like, for example, Blackstone made an investment in Bumble, the dating company, and bought Bumble as a private company and took it public. When that purchase was made, various pools of capital across Blackstone participated. We actually, within Park, made an investment, on the order of like 15 basis points in that name. When Bumble went public, that became a 50 basis point performance enhancement last year. Now it's traded off this year, but that's an example of a specific name that I would say, but I don't want to overemphasize it in terms of being like a dominant or even greater than say 10% type weighting over time. But that's an example of something.
Okay.
In the rest of our business, like I said, in like the mortgage space, in kind of non-performing loans, particularly globally, there has been kind of more sharing of ideas and kind of partnering on buying portfolios of loans, for example, and that's populated other kind of more diversified portfolios that we manage, less relevant for the equity product we're talking about here.
But the Park portfolio itself is less than 10% internal.
Yeah.
All right, thank you.
But again, I think there's also a really good window into, now we've got parts of Blackstone that are competing in situations against our managers, or we have parts of Blackstone that can be reference points of particular situations and give us a window into our managers in terms of how effectively they're underwriting and approaching particular situations that we have expertise on. So that's been valuable, even though we're still investing in more traditional ways in managers. I think over time, and again, I've been here more than 20 years, the trajectory of having more input from other parts of Blackstone that directly help us make decisions around managers, even if they're not direct investment ideas, I think has been enhanced.
Okay, thank you.
Yeah, and I would just add really quickly that it's not only sourcing that's better integrated, but one example is we have biweekly meetings now where Steve Schwartzman, John Gray, Michael Che, so some of the firm leaders participate, and the whole group has a chance to attend, and all the business heads and strategy heads provide updates on whether it's opportunities they're working on, financial result performance of the strategies. And often John Gray and others will share ideas, whether it's making an introduction or connection to a bank, for example, for an SRT co-investment space, or provide feedback on a strategy we're launching. So it's integrated better in that sense, where the firm's leadership has just much more frequent updates on what BAM is up to. That's historically existed for private equity and real estate, but BAM, given it's smaller, hasn't historically done that. So it's with Joe's leadership, it has been integrated better in that sense.
My name is Frank Nash, and one of the things is that I wonder, for all these people you keep talking about, your performance is pathetic. I mean, it's nice to throw out a lot of names of very bright people, et cetera, but the bottom line is your performance is poor. So what can you're talking about a lot of opportunities and a lot of different places to invest. And if I'm reading it correctly, over the last 12 months, you're down over 15%. And over the last 7 years, your return is 2.67%. So can you explain that? I mean,
yeah, and in the interest of time, it's probably a good segue into performance. Palak, maybe we can turn to the executive summary, and Steve, I'll turn it over to you for performance update.
Yeah, sure. So Frank, you're absolutely right. I mean, let's focus initially on the more recent performance, which again has been as tough an absolute performance environment as we've seen in equities going back to 2008. And we've certainly been right in the middle of that. I mean, you can see here on the page, on a year-to-date basis, this is through April, we're down 15% in the portfolio. And again, this is a portfolio that is 100% long short equity managers. And what are the things that are really and across that time frame, I think the market is down, as measured by the S&P, is down 13%. So we've managed to lose more money than the market, while running a beta less than the market. So obviously meaningful negative alpha. I think first you need to look at again from a what's really driven market performance and the nature of our exposure. I think first of all, probably the most significant source of underperformance has been our allocation towards growth, relative to value, or growth relative to the broader market. And again, if you think about that as a benchmark, which just to be clear, our benchmark is not the growth index, but growth stocks are down 50% more than the market on an S&P 500 basis. If you move down into mid and smaller cap, which is part of our exposure, it's even more dramatic. But the S&P growth is down 24% over that period of time. So I think, first of all, just from an outright beta perspective, with the market down as much as it is, that's your starting point with absolute performance. But the nature of growth underperformance as it affects some of our largest allocations, Tiger Global certainly being one, D1, which is Dan Sondheim, who spun out of Viking, being another. Material underperformance, and that comes both with respect to the growth orientation. It also comes with some of the geographical orientation, China being most notable as a source of underperformance. And then secondarily, we definitely, while there's a lot of managers, we talk about 35 plus managers, it's a barbelled thematic portfolio. And one of the themes or allocations from a sector's perspective has been biotech and healthcare as kind of certainly an overweight relative to the index, but a meaningful allocation, with 3 or 4 managers having meaningful allocations.
Steve, can I interrupt for a second and ask a question? How much transparency do you have to the underlying positions, and can you see that where your exposures are on a across the managers, or do you just can you consolidate positions and see if everyone's the same way, or what kind of transparency do you have?
We have very good transparency. Obviously, as equity holders, they have to file, right? So, 13F. So that's actually a fairly useful starting point. But that's
data.
It's interesting. It's actually fairly predictive. You can build models that actually track that reasonably well. But the reality is, when it comes to real transparency, we get very good transparency from just about all of our managers, whether that comes in a quarterly report or a monthly statement. And some managers, we can actually log on into the kind of prime brokerage site and actually see the positions on a more regular basis. So transparency is very good. I mean, Rob, you can speak to this. I mean, you do this every day. The conversations that we're having on a monthly basis enhance what is already, a tangible, large positions. Now, there are some limitations on the short side. Managers are a little more careful in terms of that, which frankly they should be, given some of the things that went on in the meme stocks and the short side in the early last year. But the transparency is very good. I mean, Rob, if you want to comment as well, but
yeah, I'll just comment a little bit more. Richard, you're correct. 13Fs are stale, but we get monthly reporting. Am I coming through? I have an echo on my side.
No, you're okay.
So the 13Fs we recognize are stale. On a monthly basis, we're talking with each of these funds, and they're giving us at least their top 10 long positions, which represent about 60% of their assets on the long side on average. And then we're supplementing that with 13Fs on the quarterly basis.
Sounds like you're a little behind from a technology point of view. I'm very surprised you don't have transparency through on a daily basis, because they're filing all no one anymore, is a custodian of their own assets after after Madoff and whatnot, and you have all sorts of whether it's State Street or blah blah blah, Northern Trust. All these assets are out there on a daily basis where they're verifying what each of these funds own. I'm really surprised. Do you have any project underway to get better than monthly?
So at SMA level, we actually have full transparency down to 15 minutes. And so that's about, 30% of the park portfolio. We're getting 15 minutes.
30%?
Exactly. So that's
Okay.
an
What do you-
SMA
what about
separately
the other-
managed account. And then for the daily trade file that you're referring on the custodian level, that is at the sector often. Most funds aren't giving position level data to their investors because they don't want to get their trades front run.
That's an old story though. I mean, come on. I mean, it's I think hedge funds have gotten past that.
The reality is
you have only have 7. You have transparency for less than 70. How do you know that everyone isn't? You're seeing that with all the growthiness and the concentration you had in healthcare and everything else that you can't. It sounds like your technology is behind.
Yeah, again, maybe we're not doing a good job of describing, but I would actually say the opposite. We invest a huge amount in technology, and we've got a very significant portion of the portfolio that's in managed accounts that we have full transparency. And even if you did posit that, all you had was the top 10 largest positions across this, you know what you own. To Frank's comment earlier, our problem is not knowing what we own, that we have some kind of hidden risk that we don't have transparency into. It's that we've chosen managers that have underperformed, and we've leaned in the direction of some factors and some sectors that have even more materially underperformed. And you go back in time over the track record of Park, that's happened before. The opposites happened as well. 2018, 2019, actually 2020 even. We made as much as the market, up 17%. Exact mirror image of what's transpired the last 12, 18 months. But I will say, to the longer term comment, Frank, I mean, the returns have been disappointing over a longer time. Long short equity has been extremely difficult. And, if you look at the hedge fund indices in equities, it's probably been the toughest sector to generate alpha. Now, beta has been there and markets have gone up over that time frame, but alpha generation has been really challenging for a variety of reasons. Short side certainly being one of them. And again, if you're benchmarking relative to the indices, the concentration outperformance of a handful of names, is difficult for all equity investors, long only as well as hedge funds. So again, I think we feel like we've got the same process that we use to underwrite equity managers, we're using in quant and multi-strat and credit. And I think we feel very good about that process in terms of generating ideas and underwriting managers. But there's no doubt that some decisions we've made, both bottoms up with respect to managers and top down in terms of the sector leanings, has led to kind of underperformance for us.
If you look over the past, let's say 2 to 3 years, what % of your managers have turned over, and has that been your decision, or they left, or give us some perspective on what your manager turnover has been?
Yeah, I think well, first of all, I would say probably it's in the range of 10 to 15% in terms of I'm thinking there's 2 ways to look at it, right? Capital and names.
Right.
Let's go to the period through the beginning of last year, which is when Joe Dowling joined, because I will say that names Joe's brought to the table, David Benner starting at the beginning of this year, turnover is increasing as new folks enter the process and bring relationships to the table. But I would say if you say on a trailing basis, 10 to 15% turnover. So if there's 30 names in the portfolio, you've got 5 or 6 names changing on an annual basis. I think that's a fair way to represent it.
And that's picked up recently, you said, with Joe?
Yeah, again, I think Joe came with a handful of names that were some of which were ones that we knew about, we just didn't have access to. Others were ones that we'd looked at for whatever reason past, and Joe had the team kind of reevaluate. And that these are things that probably took place over the middle part of the year, just as it takes time to do those type of things. Same thing with David and with Mitch joining as head of equities. I think you'll see a pickup in turnover, and I think there's no doubt that the dislocation that we've seen, there's going to be some choices to make. You've got a bunch of managers, the vast majority of managers that are in drawdowns, and the question is this a manager who's down a bunch and has monetized their losses and there's kind of no embedded value in the book, versus ones where everything's sold off and it's been indiscriminate kind of good companies, bad companies, and that's something you want to hold on to. And so I think that's going to be a real focus of the team, but I think that's going to lead to a greater level of turnover, just as we saw in 2008 and 2011, where those periods of time you see like an inflection point of adjustment. Hopefully you get it right and lean in the right direction in those times, but yeah, so I would say the trailing period was fairly normal in terms of turnover going back 18, 19, 20, and with Joe joining 21, I think you're going to see it pick up a little bit.
So that turnover will be, when do you expect that turnover will be?
I think again, we've got a new head of equities. Mitch Joyce just joined a month ago. I think that will start to materialize in terms of his contribution towards the back end of the year. I think, which again, I think jives well with an evaluation of what has been an extremely tough period of time, and some managers that have been particularly disappointing, not just because they're in a bad sector, but because you're observing fundamental mistakes in certain cases.
I have a question. I have a question for you, Steve, and maybe for the rest of the group, is that if the Norwalk Pension Fund was willing to stick with you in the sense that, all right, you're making some fundamental changes, how long should we wait to see that that the performance begins to turn around, or we really see the impact of all this management change and all this new blood and all this new ideas, these new processes? Can you give us some kind of sense of what the timing of this is? Or
yeah, I'd give us 5 to 10 years. No, I'm joking. No, I think realistically, 2023 would be a year of evaluation. We've got, like I said, I think the changes.
That's only 6 months away.
Again, that's what I'm saying, but I think
23 or
are
we talking
exactly? I'm not going to say 5 years, but realistically, I think things that Joe has initiated over from the middle part of last year into this year, things that David and Mitch will put in, I think are probably going to be more back-ended towards the end of this year. So, I think 2023 is probably the first time where you can say, okay, maybe there's 20 or 25% of the book that is.
Okay, that's fair.
Thank you
for that.
But I think part of it is this, are we really as bad as what this last 12, 18 months has been? Or are there things that are going to snap back and be like, oh, we were actually right about that.
Never as bad as you think you are. So that we've been around long enough to know that.
Yeah, there's a lot of volatility, but there will be things that are observably missteps that don't recover, and there hopefully will be things that snap back. And I think that process itself, you would certainly hope over the next 12 to 18 months you'd have a window into that as well. If our big bets with a D1 or Tiger Global, if those firms are kind of wounded in a way that they're de-risked or pressured in a way, it's certainly not going to run the redemption side, because I think they're very stable asset base wise. But those are the types of questions I think you as a board and us answering to you, should be able to have some more color on.
Steve, has there been any changes to the portfolio positioning. You mentioned Tiger Global, who's been in the Wall Street Journal, being down 50 to 70% year to date. Curious on the positioning versus last year. Has there been any changes in terms of the themes embedded in the portfolio or the managers year to date?
Yeah, again, I think, well, it's different. Clearly, there's been a huge kind of repricing of, I mentioned the term earlier, unprofitable tech, which is this kind of, early growth, the non-FANG type part of the market, to simplify things. I think that's still very much, unsettled. It's certainly not something that we're stepping into and saying, this is now really cheap. I think areas like biotech, though, are the type of thing that, I expect will be picking away at on the margin as you have parts of the market that are companies trading less than cash on the balance sheet, that are completely discounting their forward pipeline to, less than zero, because, and I think that type of opportunity is an area where we're focused. I think energy, same thing on the opposite direction. You've had everything's just gone straight up as oil prices rallied, and some things probably should have, some things shouldn't have. So I think the ability to kind of parse through these sectors that have really moved in dramatic ways, just as we did with the financial sector, post-financial crisis. I think those are the types of areas we're focused on. And so that sounds thematic, but ultimately you've got to go down to the manager level and say, are these themes expressed with these managers, or do we need to reposition? Obviously, the one thing that is almost like a bid-ask spread you need to think about is high water marks. You're not going to stick with a manager just because you have a high water mark, but to fire a manager that you're not going to pay incentive fees to for the next 2 years, to give money to somebody that you're going to pay fees to day one, I mean, that's got to be part of the analysis as well.
Yeah, that's a great point. One of the questions I have, following your comment just then is in general, are you subject to the 90 end of quarter 90-day notice, 90 days before you get your money out, or do you have different terms? Because if what I'm thinking of is, the timeline we laid out to where it's going to be towards the end of 2023 before we see it, we should give you to the end of 2023. Is 6 months of that just part of turning the oil tanker around, or because of the gates that you have, or the liquidity constraints?
Yeah, again, different managers have different terms, but it's, as you probably know, post-financial crisis, most managers moved away from fund level gates to investor level gates, so you can get 25% of your money out a quarter. And so, yes, it's you can't snap your fingers and blow some manager out and replace it. We do have credit lines that kind of close the gap from, the time you redeem to when you actually get your cash back, so we can bridge that, which helps a little bit. But yeah, I mean, I think there's a, Tiger Global, for example, the terms are at the less liquid end of the spectrum. If we wanted to, move away from that, and I'm not saying we do, but to the extent we did, that would be a longer drawn out process, because that's a multi-year liquidity.
All right, that's
But there are,
I wanted
the managed accounts that Rob referred to that are 30% of the portfolio. That's liquid on a monthly basis with 61 days notice. So there's a huge amount of liquidity in the portfolio that we could pivot to the extent those are the places we want to draw that liquidity from.
I have a question. As far as, like, if you don't have a real clear transparency, theoretically, you could have a manager who is short a stock and a different manager who's long the same stock, and you wouldn't know it. Is that right?
Yeah, again, particularly on the short side. On the long side, like we said, with the transparency we have a really good picture on aggregate basis of anything that is, Rob, probably north of a 50 basis point position on a look-through basis. So on the short side, though, it's a short side, it is more limited and more episodic. A lot of it comes out of conversations more so than seeing positions on a page. But yeah, there's an inefficiency there. Again, I wouldn't, I think the aggregate short positioning relative long, it's quite unusual to see something that is in aggregate and meaningful long position to see an aggregate short position that's meaningful in that same name. But yeah, that's certainly, there's an efficiency there to be on both sides of that trade and potentially paying incentive fees to one manager while the other manager is losing on that same name. So I think that's inherent in hedge funds and inherent in all the numbers that you see.
Do you set yourself, or who sets the idea of how long or short you are? I mean, I know funds move up. I text somebody often on a daily basis. He runs a fund, and one of the things is he'll talk about his net long position, basically. And do you set that, or do you just tell your managers to do whatever's? In other words, could you be, say, 70% long, 30% short in the fund, or you decide to be 55 long, 45 short in the fund? Who makes those decisions?
Yeah, so for the most part, the managers make the decisions around their individual fund, right? So, and you're right, some could move quite dramatically from being 50% net long to neutral as they lose money and markets draw down. What we do, and with the transparency we have, that's one of the dimensions that managers report to us, which is their net gross and net positioning, such that we can aggregate our portfolio and look at our overall net and gross. And we run the portfolio that you're invested with, targeting a 0.6 beta. So to the extent that now beta doesn't necessarily match exactly to 60% net long, but that's something that we manage our allocations to be in that range. Now we have flexibility to move that, but in general, we've been around a 0.6 beta, which is, there's no magic to 0.6 versus 0.4. And I wouldn't represent that we can add a ton of value by moving the beta around, tactically in some way. But I think expectationally for investors to expect a beta like 0.6 and then, judge alpha, positively or negatively around that is how we've set up the product, just, for investors' expectations as you think about its role in your portfolio. But it is the managers themselves are completely dynamic. Some are, move within a very tight band. Some, tactically may move quite dramatically. And then we also have a number of these managed accounts where we actually task the managers to run in a market neutral context. So, we have some managers that run quite long, close to 1 beta, others that we run, quite hedged and direct them in that way to do that. We generally find though that the biggest takeaway is don't ask manager to do something that is not kind of natural to them. If you ask a manager who typically runs 70% long to run market neutral, that generally ends in sadness. You want people to operate within a framework that they're comfortable with, and frankly the way that they run their money. When you try to morph them into something different, that generally doesn't have a great outcome.
Agreed. Are there any other points that you want to make? I know we threw a bunch of questions at you, but are there some?
Yeah, I guess the last point I'd make is that obviously with hedge funds, long only you've got alpha relative to benchmark, but the tricky thing with hedge funds, which can be both a value creator as well as detractor, is the short side, and that's been probably one of the more challenging aspects of this most recent period is the inability for managers to generate alpha on the short side when markets are collapsing and stocks are going down. You would think that would be a great time to generate alpha. They're making money on the shorts, but their shorts are not going down more than the market, and I think that's you're losing money.
Then they have to close out the shorts to make their margin calls on the long. So it's a tough.
Yeah, I mean, the more difficult period was early 2021 when they were getting crushed on these shorts, the meme stocks, so to speak, the GameStops and such, and they had to cover their shorts and reduce their longs to keep their balance sheet from just expanding as they lost money in that period. So, and whether that is something more like a secular type of shift that is 10, 15 years ago, people were able to consistently generate alpha on the short side. If that's something that can't be done going forward, I think it's something we need to reevaluate in terms of the ability for alpha to be generated, in long short, because as Frank pointed out, like, there's been negative alpha on the short side for a longer period of time that has led to an offset to the gains that markets have naturally generated, and has made it really challenging for long short equity managers to put up absolute net returns. And we haven't helped ourselves with some of the tactical choices more recently that I've mentioned. But again, I feel like, the process is there, the leadership's there. I think we've seen these things, have volatility and bands over a period of time. And I certainly can represent. I don't think there's a broken process or a lack of focus or capability on the team. But it's not showing through in the numbers. And we'd be the first to admit that.
Thank you.
Well, we appreciate your time. I know we took almost an hour instead of the 30 minutes allotted, but appreciate your spending time with us.
Thank you. Yeah.
Any other questions? I don't know that we have to go over any of the other slides.
Any questions on individual managers or sectors? I know we spoke at the high level about the sector exposures and what led to the underperformance, but any manager specific questions?
Nope, I don't think so.
Nope. I think that's it. Britt,
Good discussion.
anything else you want to ask? Brett?
No, thank you all for spending some time with us tonight. We appreciate it.
Of course.
Thank you very much. It
Yeah.
was
Good. Thank you.
informative. Thank you.
Thank you
Okay.
for all the
you.
questions.
Thanks, everyone.
Thank you.
Thank
Okay,
you.
have a good evening. Take care.
Anybody want to discuss what we just heard?
Well-
You were, by the way, excellent, Richard.
Thank you.
Is that like?
I've been
I
here
think there
before.
looks like there's points above you. There might be a little star there that you're,
It
look at
is.
that. He's our
There it
star
is.
guy right now.
All right.
But
Right.
anyway, where I would like to go with this is for them to present what are they putting in place? They've had a lot of changes. They brought a lot of new management in. What can we expect to change over the next 12 to 18 months? And then how can we measure whether those changes have been effective or not? And for me, that is, obviously with bringing all these new people in and all this new stuff, they have to realize that the wheels are coming off the cart a little bit, and they're making some changes to try to get things back on track. But how long do we, one is how long do we wait? And two is their direction consistent with what we want to do as a fund? I mean, we don't want to, the point I made on liquidity was that, we're in a drawdown, not in a building situation. We're not trying to compete with Harvard or Brown or these other endowments that never spend their money. We're spending our money. And so how they are planning to evolve matches with our needs, I think is very important. Now, we may say that I'm out of here for our 20 million bucks, or we say, all right, let's give them, let's see what they say and look in the fall of 2023 and how they did. I don't know. What are your thoughts?
Well, I don't think our liquidity, issues are really that much of a concern right now. This fund's going to be around for a long time. And whether we dial back our investment in them a little bit, maybe, but I don't see, I don't think they're talking about a 20-year horizon here for their returns.
No, but I thought it was a useful, a useful way of lining up, our objectives the same as theirs.
Right.
And the fact that he ran Brown or whatever for a while, and they have different needs.
Right.
And we have to align, I think, our managers' needs to what our needs are. When I agree that we're not talking we're talking 20, 30 years. Are they talking 50, 100 years? I don't know.
Yeah, I'd be surprised, but I guess my sense is it sounds like they're maybe 10 or 20% into their process of turning things around in terms of picking new managers and so on. They got a long way to go on that. The Dowling's new, the head of equities even newer.
Yep.
So they're not going to have a new lineup in place for 9 months probably.
Yeah, absolutely.
And then we've got another, whatever,
Yep.
year, 9 months to a year to wait to see how they're performing. And so I don't know. It's I guess Britt, do we have a way? Do we have transparency in terms of their manager turnover? Do we see who they've got in their lineup month to month?
We can certainly request it. Obviously everything is confidential to them, so we can send it offline, but can't make it publicly available. But we can get a list of their managers. We have commentary on what's driven underperformance. Certainly happy to share that. I think from a Callan perspective, the Joe coming in, we've had a number of calls with him. He's obviously a very good investor. I think in general, the hedge fund world is not exactly a growing business. And BAM is right there in that boat where this business has kind of stagnated along for quite a few years. And they brought Joe in to try and grow it and try to bring some energy into it. I do agree that it is going to take some time for this ultimate portfolio to be implemented. And, it's been disappointing, certainly the last 18 months. I think, the fee structure is in your favor going forward from here. We can discuss that in the fee analysis, but it is an incentive fee with a high watermark. So, them doing terrible to start the year is certainly going to incentivize them to turn things around. So I think in general, we do believe in the team and the direction they're going, but noted that, there's got to be a leash at some point where, you can't stick around waiting for this magic to appear with this new team. Because there is
the thing is, it isn't, I don't mean to cut you off, but it isn't that, the performance in the last 18 months has been bad. We all see that, but look at 7 years.
No, it hasn't been great going back either.
It hasn't been great for a very long period of time. And it's
the amount of performance we've given up for the supposed lower sharp just doesn't seem to be worth it.
Right. And so, and by the way, one of the things is when they were talking about all these new people coming in, this goes back years ago to a meeting, and I'm not sure that Jim and Rich were on the board at the time. They might have been, but Tom was there, and this guy came in, and all of a sudden he starts talking about, we hired these new people. We hired Ben Bernanke, and I'm there going like, it's like, I don't care what the guy's name is. I care about what his performance is, and first of all, the people higher up who hired these new people drag their feet because they've had poor performance for a long period of time. And I don't, my understanding is that we've talked about this, is that, look, the long short fund is going to be, when the market's up 10%, they're not going to be up 10%. But when the market's, up 20%, they shouldn't be down. I mean, that's kind of like, and if you look, I mean, their benchmark on here is the S&P 500 index. Over the last 7 years, it's up 12.3%, and they're up 2.6. I mean, come on. And somebody once said to me, long short funds are basically like, they're always longer than they are short, right? I mean, let's face it, there's very few long short funds that you look and they go, yeah, we're net short. They're always, almost always net long. And these guys they're picked. I don't know about, I wouldn't be opposed to, like, taking the money and looking, and rather than keeping the money with them now, leave the fund. And then if their performance is good in 23 and 24, we can always put money back in. But it seems like we're taking a risk here.
You think we park it in fixed income, Frank?
Well, I'm really liking to lock in. Hey, listen, think about this. Right now, over the last,
Fixed income would have
they
done
returned
better.
2.67%, which is less than the 10-year. So we would have been better off buying the 10-year. Good heavens. That's
With a lot lower fee.
with a lot lower fee. That's right. I mean, so what does everybody think? Joe,
Yeah, I'm inclined
Charlie,
to
what do you
agree
think?
with you, Frank. Take the money out. I mean, all I heard him saying was that the people we had picking these funds didn't pick good funds. So we're going to bring in some new people who are going to pick some different funds. There's no change in the process. There's no change in the algorithm or anything else. They're just going to rely on somebody else. That's what we did 7 years ago, like you had said. They brought in some new people to pick some different funds. Now they're going to bring in more people to pick some different funds. And we got to wait another year and a half or longer to see whether it works. I'd rather go with somebody who at least is returning something more than, I mean, since 1999, their return is below the market, below all the indexes.
Rich, one of the things, by the way, I didn't mean, I know you're going to speak, but when you talked about the transparency, and when I asked them, I said, you could actually have one fund manager saying, I think Tesla's bad, and short it, and another fund manager at the same time long it. And they wouldn't even know it.
Yeah, but that's okay. That used to happen at 0.72 all the time. And someone's going to be right, someone's going to be wrong. And that's to me, that's okay. What I was looking on the transparency is that they didn't know, or they didn't appreciate how much their growth exposure was, or how much, sector exposure they had to biotech, or how much, to fake it until you make it technology they had. And so to me, it was a sense of that they didn't know what they didn't know. And that was more of a concern for me than okay, we knew this, we took a bet, and we were wrong. That's okay. I mean, that happens. But to say that, oh, we had transparency to 30%, what about the other 70%? Or, we can see it on a monthly basis. Or the 13Fs. Oh, come on. Your 13Fs are 3 months old after that was the least reassuring part of the discussion that I heard.
What do you think, Jim?
Off mute. is this really also much a discussion about hedge fund performance in general? I mean, because their performance, if you look at the HFRI index, it hasn't been so hot either. You know, they haven't been really much worse than that. They were the last year, but this is, I think, largely a discussion about how poorly hedge funds have done over the past 5 years, and how much do we want to allocate to that segment, to that asset class? Because look at the index. It's been going back to 84 months ago. 2.7, 3.8, 4.3. These guys have been within 100 basis points of that every year until the last 12 months. So I think we're really talking about how poorly hedge funds have done. What do you think, Britt? Is that a good chunk of this?
I think that is spot on. I mean, to your point, the HFRI strategic index is a much more reasonable benchmark of hedge fund peers to compare them to. And you can see the returns have been terrible across the board. We can certainly revisit the asset allocation. I would note that the current target to global equity long short is 8%, and that's split between the two portfolios. The minimum or the lower range target is 4%. The liquidity for Blackstone is quarterly with 95 days notice. So, even a partial redemption, it's going to take 6 months. I don't think we would recommend a full redemption at this point. We can understand trimming and reallocating assets in higher conviction areas. And as we reevaluate the asset allocation, to your point, Jim, I think that is the real discussion here. Is this a place that the board wants to continue to invest in when we've seen, the diversification benefits have not paid off really at all?
Or if you want to stay here, do we have an opportunity to do more with ABS Global?
You do. They're very different managers. ABS tends to invest in much smaller managers, and really is very different than Blackstone. So they tend to complement each other well. You can certainly increase the allocation to ABS, but I think right now it's at about a 4% allocation. I don't know that we would want it to be the full allocation, but I'd have to discuss that with our hedge fund research team to really understand the concentration risk.
I mean, do we think Blackstone's, do they have a benchmark, or do we just put the S&P there?
So you'll, if you read through their disclaimers in their presentation, they specifically will state that they do not manage to a benchmark.
Right.
Which is, the amount of times and conversations we have had trying to get them to make a benchmark in most of their strategies is nauseating. We think
if you were Callan,
reasonable.
I was going to say, go ahead.
Yeah, no, I think that's why we have the strategic index there, to show how peers are doing, to measure them. And that would really be our dominant benchmark for them in this space.
I would hate to, just like everybody else, I don't want to sell at the lows, but by the same token, I don't want to hold on to something that's fundamentally broken. And so I think the question of changing allocations from hedge funds is one thing, versus is Blackstone fundamentally broken?
Right.
And do we say that, all right, these guys are broke? Is there a better alternative in this space? What's your comment on that, Britt?
I mean, I don't think that we view Blackstone or their team or process as broken. We certainly understand. I mean, I would say this has probably been their worst performing strategy that I've seen across my client base. We can certainly look to see if there are other managers out there and bring those to the board to see if, you know, there's a potential replacement that might fit the board's objectives in a better way. Certainly understand the concerns that everyone has spoken about tonight. So we're happy to see other peers and see who else is out there that we have a conviction in and bring that.
Good,
to the board.
please do that.
You know, one of the things that like Jim mentioned, I'm not as big on the long short funds personally, but that's a decision for the whole board. But even if we decide to keep money with long short and change managers, we should be taking the money now because it's going to take time, right? Don't we have 90 days or at the end of the quarter after that? So we would have to decide this month and we wouldn't get the money for another 3 months. Is that correct, Britt?
I don't know when I think you'd have to decide now and you'd get the money in December.
In December.
Wow.
Yeah.
And then didn't we put in a redemption for 5 million?
Yeah,
For that we did at the previous meeting, and we'll end up getting the money in September.
that's what I thought.
Okay.
Yeah, I think so, yeah. Yeah,
I
it's
mean,
in the minutes.
do we go back to them and say, tell us how things are going to be, things are going to be different in the at the same time, look to see if there are some better alternatives, and you know, 3 and 6 months we will be at a better position to make a switch. And if we make a switch in let's say September or December, you know, we have things reallocated by June of next year.
Well, I don't think they're gonna be able to be very definitive and precise on what's going to change. I mean,
Well,
in the
then
process of
that's a
replacing,
lot, right?
well, they're replacing managers, and I don't think they know who they're gonna go with yet.
Right.
Well, but they have
thing
to
is
have an overall philosophy.
Right.
Well, do you think they're going to say, yeah, we're going to still be bad? I mean, let's face it, they're going to say, oh yeah, all these changes are good. You know, and there's a lot of companies like we can look at, you know, stocks that are trading down and they've had management changes and everybody's changed strategies, you know, you know, I guess we're not going to get if we can't even get the money till December, I mean, then we could decide whether that's a source of funds, because we're going to still need money. I don't know how much Chitsame needs. Chitsame, if you're there, do you have an idea of how much cash you need?
Yeah, so I know we did put a redemption in from Blackstone, about $5 million. And that redemption, we won't get the money until October of this year. Right now, our cash position, we're at 6 million, and we have a pension payroll due this month of approximately 3 million. So by the end of June, we'll have 3 million of available cash, which gets me through July. So in July, we have the fiscal year 23 city contribution that's going to go in 15 million. So out of that 15 million, I will need 6 million to get me through August and September.
So you're good for a while.
Mhm.
Yep.
Excellent.
I guess my sense is, I guess my recommendation here would be to have Callan look at some alternatives with the goal of revisiting this in September and making a decision on what we want to do in the long short space. Do we want to maintain our asset allocation to that segment, that asset class? And if so, who do we want to pick to manage the money?
Well, I think the first decision would be, regardless of whether we stay in that class or not, do we take the money out and find a new manager? So we should decide whether we're going to take money. Basically, so we have 20 right now, right? We have what, 20 million with them, right?
20, yeah.
A little less.
A little less, but
19,
we've
yeah.
also requested 5 million out of that.
Yeah.
So really, we only have 15 million with them,
Yes.
right? So do we, that's one of the smaller segments that we have. We're gonna need money in December to fund, the pensions, right? Because the money that the city contributes will be exhausted by then. And is that the source of pension payments for January and February?
If we decide not to allocate to the sector anymore.
If we decide not to allocate. But what I'm saying is there should be two decisions here, right? First, do we take the money out from them, yes or no? And then second, sometime Britt can show us other, long, short funds, and we may decide to go with them, or we may decide not to go with them. We may decide to keep money in that field, or we may decide not to. But the first decision would be, do we stay with them now? Because if we stay with them now, then it's a moot point. We don't need to go look for a search, because again, we're not going to get the money till December.
Well, one thing is we mentioned the high water mark and fees. Are we basically what's our fee structure look like through the end of the year for them, Brett? Is that something you'd have to research and get back to us?
No, so essentially the park strategy is offered in 3 different fee structures. There's a 1% management fee. That's one option. Second option is a management fee and an incentive fee. And Norwalk is in the incentive only structure. So essentially it's 15% incentive fee with a high watermark. So when we go through the fee analysis, I can point you to the page that details all of that. Needless to say, the year-to-date performance with the high watermark has hindered their ability to collect an incentive fee for quite a while until they dig themselves out of this. So I think that does help Norwalk in knowing that you're not going to be paying fees, and knowing that they're losing money because they are not able to charge an incentive fee to any of their clients at this rate. So we think the fee is reasonable. There are some performance fees in the portfolio, which understandable, why you would want a manager to manage money with an incentive and line interests. So I think for the foreseeable future, based on the terms of the fee structure, Norwalk's not going to be paying any incentive fee to Blackstone.
But we did pay $136,000 in 2021, right?
Correct.
And their performance, I mean, we're looking at the last 12 months, they were pathetic. I didn't understand how we paid such a high fee to them when they lost money in 2021.
I have to pull up the full quarterly report. My computer is, of course, having lots of issues right now. Bear with me.
Well, I mean, I'm looking at, so the last 12 months, and this is the April report, they were down 15%. So
How
unless
about
they had,
How about in 2021 though? If we paid them fees in 2021, what was their performance?
well, that's
in
what I'm saying. We
2021?
paid 131,000 in 2021. Now,
Right,
report we have for the last prior 12 months that we've got here is that so that means that, remember, this is only for April. So
Right.
that's 8 months of 2021. They're down 15%.
Oh, I mean, but the market fell apart in November. So they might have still been above their high water mark.
Well, I could probably look, you gave me some time. If Britt, you could probably look at
You
the
have
one
all
that
the
we,
time you want, Frank.
no, I'm just saying that.
Just as long as it's not past 8 o'clock.
Yeah, I know. I was going to say without Joe here, this thing could go on forever. But anyways,
So
I was
Frank,
surprised at how
there-
high the fee was with the fact that their 2021 seems to have not done well.
You are correct. The issue is the incentive fee is not off of a benchmark. It's off of basically any positive return. So on the calendar year, they did have a positive return in 2021 of 1.9%. So that is why the fee, I think it equates to about 57 basis points. Not saying that it is, I'm not saying that is Norwalk friendly by any means, but that is how the rationale works for what they earned.
Okay, so does anybody want to propose that we take the money out or not? Anybody
Yeah,
have any?
Frank, I'll move that we take all of the money out of Blackstone, hold it until we get recommendations from Britt, and then determine whether we just use it for pensions or invest it back into another manager in the same sector, or put it someplace else. We're
Is there-
open to those recommendations.
Is there a second to that? I just don't want to split vote here. Do either of you agree with that idea or not?
I honestly don't have strong feelings one way or the other. I think on some part of me says the right benchmark for them is the HRFI index, and they haven't really done that badly against it. They could have, would have been nice to do better. There's a broader question if we want to be in the long short asset class.
Right, but we could make that decision later. But is there a second to that motion? I could,
I mean, they're not going to cost us any money for the rest of the year in terms of fees, but will their performance be worse? If we go into a new fund, we're buying the bottom on them.
okay, well, I'll second it then. So then we'll have a vote and we'll decide. Okay. So there's a motion to take the money from Blackstone and to have it set aside possibly for payment of pension plans, or to after a discussion to whether we use the funds to continue to invest in long short. Is that good?
Yes.
And Frank, just to clarify that, so if we decide to stick in the long short asset class and put that money with another manager, you'd still have a funding issue for the pension requirements, right?
Right, but we won't get this money. Remember, even if we vote now,
Right.
we're not going to
December.
get this money till December.
Got it.
So really, like the idea of fees for the year, the idea that we're below the high water mark, it's probably going to be moot because
Doesn't
there's
cost
not going to be
us
any
anything.
fees. It's not going to cost, we're going to be here through December regardless. Okay? Is there any other discussion? All in favor of the motion?
Aye.
Opposed? No, passes unanimous. Thank you very much. I appreciate that. You're having too much fun today, Rich.
We're a tough crowd. We're looking out
Okay.
for our pension.
Right. Well, that's what our job is, And okay, so Brett, performance review. Skip the long short fund.
I don't have anything good to say when it comes to April performance. But just to confirm before I jump in, So we will try to identify, a short list of candidates of global equity long short managers. We are also doing the search for artisan and planning to present that in September. So I want to be cognizant of the agendas for September. So would you like us to bring that short list of hedge fund managers in September or October?
October's fine.
Yeah, I agree.
Perfect. All right, underperformance. So for the pension at the end of April, total assets were 483.6 million. As you all know, it was a very volatile quarter in April as Ukraine invasion continued, central bank tightening, inflation, as well as all the COVID lockdowns in China. We saw bonds traded lower, commodities outperform during the month. I think the one positive aspect here is that May was a positive month for equity markets, and month to date in June it has also been positive. So while for the year it's certainly been a volatile and negative investment environment, May and June so far have turned it around a little bit. So at the end of in April, we saw about 28 million in unrealized investment losses and about 3 million going out to pay pension benefits. In terms of performance, fiscal year to date, your US equity active managers, LSV and Columbus Circle, have done extremely well on a relative basis. You can see how much worse SMID growth has done, down almost 25% fiscal year to date. Columbus Circle is outperformed by about 5 percentage points. And LSV, who struggled for a long period of time in the growth market, has outperformed their benchmark by about 8 percentage points fiscal year to date. So great to see them continuing their performance. In international markets, Artisan has underperformed their EFA growth benchmark fiscal year to date through April. They did outperform by about a percentage point in May, a percentage point in April, and about 2.5 percentage points over the benchmark in May. So they have turned it around a little bit, but that's not played out in their performance. And you can see Silchester, some slight underperformance, but longer term, they continue to do well. BlackRock has struggled. Most of that negative performance has been tied to China, as we've seen China really driving underperformance in emerging markets. And that strategy does have some investments in China that are a little overweight versus the benchmark. I will forego global equity long short given our discussion, but if we turn ahead and see fixed income managers in this really rising interest rate inflationary environment have really struggled. Both of your managers have slightly underperformed fiscal year to date, but are doing fine longer term. And I think the real bright spot of the portfolio has been absolute return manager UBS, who's up about 7.7% fiscal year to date, really showing how differentiated their process and strategy is. So good to see them performing very well. And then lastly, PIMCO has underperformed slightly negative for the fiscal year, most of that driven by their equity exposure, particular in emerging markets. But longer term, the fund continues to do well. So through April, the total fund down about 7.4%, does not take into account updated private equity marks. And the last 12 months also negative, but longer term returns continue to be strong relative to the discount rate as well as the benchmark.
Any questions?
Nope.
Do you want to go over the management fees in this meeting, or do you want to do it in OPEB?
Why don't we do the pension managers in this meeting, and then we'll jump to the OPEB ones in the OPEB meeting, if that's okay, Frank.
Excellent. Okay, so managers fees then.
Great. So this fee analysis, it's been a few years since we've done it. Most of this information is is sourced directly through Callan, whether it's published manager fees, which are essentially, if you, before you start negotiating with a manager, what are their kind of off the shelf fees? And then we also use what are Callan clients actually paying. So when, we hire a new manager with our clients and then start negotiating and get those discounts, what do the actual fees really look like? So we have a couple sources of information to compare these manager fees to. On page 3, we do want to caveat this is we're not looking at performance in this analysis at all. It's strictly management fees. Some of the managers, we don't have a relevant peer group per se, or there might be some differences in the peers. So we do want to caveat that with that notification. On page 4, we have a summary of the pension managers. By and large, fees are extremely competitive. You can see the list in the middle, all well below their median peer fees. I would point out that BlackRock, Emerging Markets, and LSV do have a lower management fee, but also a performance fee. So we don't have the ability to benchmark performance fees. Just wanted to caveat that. In our discussions with the managers, we were able to engage with BlackRock on the Russell 1000 Index Fund for a slightly lower fee. They are working on pulling any documentation needed, but that fee will be reduced going forward. And then we did want to highlight that the Core Plus manager TCW, you can see the current fee. Norwalk's in the mutual fund, it's 37 basis points, which is a competitive fee for a Core Plus fixed income mutual fund. But they also have a CIT, commingled investment trust, that the pension is eligible for. And that would be a 7 basis point reduction in fee. And we think that's worth pursuing. Shouldn't be too complicated for Northern Trust to handle another commingled vehicle. And we think the fee savings are worth pursuing if that's acceptable to the board.
Yep, sure.
Great. So we'll work on that.
Good.
Chitsmay, I'll work with you to make sure we get all the right paperwork in place.
Do we need
And
a
then-
motion to pursue the lower fees for both managers?
I wouldn't think so. I don't think so. Frank, you
That's
agree?
just it. Yeah, I think that's more administrating the fees that I mean, it'd be kind of seem like,
Unless you want to have it in the minutes, right?
yeah, but.
Well, you
I
said
don't think
Callan recommends Norwalk transition. So it seems like Callan's recommending we make a decision. Sounds like we
Oh,
need a
you're-
motion. but-
Okay, yeah, that's
but
fine.
I'm not- I'm not-
Actually, you're a legal person, so you could propose a motion.
Here, I move that we seek the lower fees with TCW Met West and with BlackRock.
Is there a second to that?
Well, I would also add lower fees as recommended by Callan.
Right.
Yeah, right. So it would be amended for those
Yep.
two specific, but any other, that
Right.
way they're excellent. Okay,
I would second that.
and any discussion? If not, all in favor?
Aye.
Opposed? Did you
Great.
vote, Jim?
Yes, I said aye.
Okay, excellent. Passes unanimous. All right,
And I would caveat all of this with we did confirm that Norwalk is invested in the cheapest eligible vehicle in each strategy other than TCW. So I did want to make sure that you were aware that there aren't cheaper vehicles for the other funds that Norwalk would be eligible for based on the assets. And then finally on page 5, I just wanted to highlight there are 3 funds with fees higher than median peers. There's one international equity manager we plan to bring candidates to review in September. So while the fee is higher, we're going to look for replacement candidates there. They do offer a separately managed account option for 10 basis points lower, but when it comes to international equity and international markets, custodying a separately managed account, it can be significantly more expensive on the custody side. And we wouldn't recommend pursuing that at this point. And then the other two, you can see both close to their median peers, but we don't feel that they're unreasonable by any means. And both funds continue to perform as expected. So no concerns on that front.
Thank you.
Any questions? Any other questions on that?
No.
I'm good.
Anything that, Chitsame, we had a discussion already about funds you need. Has there been any capital calls or anything that from private equity?
I haven't seen any.
Okay.
Frank, I did want to, I know that Chitsame will have the cash with the city contribution to pay benefits through September. There will be about 9 million that the board could invest once it hits the pension plan from the city's contribution. So we did have a recommendation to invest the remaining proceeds that weren't needed for cash needs, if you'd like to review that.
That'd be fine.
I'm gonna just
Is
pull
it,
up my.
is it fixed income?
I
How
wouldn't
long are the
dare.
bonds
I
we're gonna
wouldn't-
buy?
I wouldn't dare. Can everybody see the screen here?
Yeah, thank you.
Great. So, I think Chitsame sent over some details. The total city contributions expected to be about 15.2 million. So we're suggesting leaving 6.2 million in cash to pay benefits, which should, Chitsame, I believe that is plenty for you to get to September. And then we were suggesting, the total fund is most underweight to equities. You can see about a little over 2% underweight in US and a little under 2% underweight in international. So we're suggesting 4 million to BlackRock, 2 million to LSV to really bring Columbus Circle and LSV in line with the growth value, tilt being more neutralized, and then adding a little bit to Silchester, given their track record.
When are we gonna need, money again? Is that going to be in December, or is it going to be a longer period than that? Are we?
So we would come back in September is kind of the new plan.
And so we're talking about $9 million for 3 months.
It depends on what we do with the Blackstone money, right? So
Well, the Blackstone money we don't see,
that's December, yeah.
right?
But the money comes in July. We'll be meeting in September, so it's really 2 months.
Yeah, that's what I'm wondering.
Yeah, I mean, the only other thing is, one of the things is absolute return seems to have consistently done okay. But I'm fine with, do you think that we should just keep the cash? Rich?
We
You can buy T-bills with it. I mean, bills
no,
are paid.
I mean, that's that to me is not an unreasonable alternative, because we're basically on I would say that Silchester is a longer term investment, but the other 6 million is maybe the LSV and Silchester is a longer term investment. The 4 million into BlackRock, to me, that's a, do we just keep that in bills, or do we just or do we see what the market's going to do for 2 months?
My own view is we should invest it, because we have asset allocation guidelines and we should stick with them. And that means you tend to buy in when your one asset class goes down. And if you don't do that, I think you're trying to do market timing, which is, I don't think something a pension board should be doing.
Okay, that's fair.
That's true. However, one of the things is our targets, if you remember, they're very broad. I think we can be as low as 55% in stocks or 60% in stocks. And we
Mhm.
can be up to 0 to 5% in cash, I believe. So we wouldn't be violating anything if we put the money in T-bills. Just
Agree,
as,
agree, but you're basically market timing. As long as you admit that.
I'm not admitting anything. I'm saying that we're looking at,
I
we're
will.
looking at, to me, it's like, Rich has got that star behind him. And if we buy T-bills, that's like buying like short-term, bonds just about. I mean, so.
I mean, I don't disagree with you, Jim, on the market timing, but we're looking, the horizon's so short for 2 months.
Yeah, I'm okay either way, because there's a lot of people that are, a lot of intelligent people think we're heading for some bad times still.
So would that be, is there a motion then, Rich, to have whatever you'd like to be put in treasury bills?
What I would move to move 2 million into LSV, 3 million into Silchester, and 4 million into T-bills or equivalent.
Run those again. You got three for Silchester.
3 for Silchester, 3 for LSV, and 4 million into T-bills or I guess T-bills. Closest.
Yeah, I
to
guess,
the-
Rich, one thing, I'm not sure that you have the ability to just buy T-bills in this portfolio. We'd have to talk to the custodian and.
Well, or an alternative.
Leave it
Don't
in
we get,
cash would be
Yeah.
typically
Right,
the
but-
process.
but the cash position, I mean, isn't it, I hope it's an interest bearing, not just a
Better
simple
than
money
30
market.
basis points.
Right, that's what I'm trying to say. I mean, I know I bought some 6-month bills today, they're 175. I mean, if the 3-month bill's 1 1/4, I mean, 1 1/4 is better than,
What's our cash in Chitsame? Is it under a mattress somewhere at the city hall or what?
No, it's at Northern Trust.
In what? It's just
I think it's in a regular money market, so
Money
it's
market account,
whatever
okay.
rate, it's the ongoing rate right now.
mhm.
I mean, I know it's been low the past year, just as we've seen with other
Yep.
regular money market.
It's a stiff, I think, short-term investment fund. I mean, there is some yield
Yep.
there. It's probably not as good as a 10-year by any means, but it is earning something.
Yeah. And it's basically risk-free. Yeah.
Right.
Okay.
but could we invest in T-bills? I mean, wouldn't that be like fixed income? It's just a matter of shorter duration, that's all.
Well, the issue is we don't have a vehicle to do that.
Yeah.
So
We don't have a
have-
treasury direct account.
I'm sure
So-
Northern Trust could buy T-bills for us.
So I should I change the motion to an appropriate cash alternative? Is that more fitting with our abilities?
But-
Rick,
I think so.
okay.
Okay, so there's a motion.
But Rich, before you do this, Rich, Britt took his screen away, but were your numbers a million short of what he had there?
He had 2 million for LSV, 3 million for Silchester, and there was 4 million for BlackRock,
So, okay.
right?
But there's a total of 8 million, isn't there?
Well, I think it's like 8.8. If there was
Right.
There you go.
6.2 we need in cash, then there's 8.8.
All right, there's the new
Almost
number.
nine.
So
Yeah.
10-2 going into cash.
And that cash is not going to be this high, right? Because benefit
Right.
payments have already been paid out of here.
Right.
For 2 months, so
Okay.
certainly going to be much lower.
All right, good. Yep.
Okay, so there's a motion for 3 million to Silchester, 3 million to LSV, 4 million to a cash equivalent account. And is there a second for that motion?
Wait a minute, did you say 3 million to LSV or 2 million?
No, 2 million LSV, 3 million to Silchester.
Okay,
Okay, right, 3 million Silchester, 2 million LSV, 4 million to a cash investment account.
I'll
Is there a
second.
second?
I'll
All in
second.
favor?
Aye.
Aye. Opposed? No. Passes unanimous. Excellent. Anything else, Britt, or anybody have anything? And if not, is there a motion to adjourn?
Motion to adjourn.
That's, seconded it.
All in favor? Aye.
Aye.
Opposed? No. Excellent. Okay, next.
Seven.
OPEB. We have an OPEB meeting today. Call the meeting to order. Review the minutes of the last meeting. I found no changes. If there's any changes, is anybody that's from March 9th? Any changes? And if not, is there a motion to accept the minutes?
Move to accept the minutes.
Is there a second?
Second
All
that.
in favor? Aye.
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 Opposed? No. Okay, any public comment? No public comment. Thank you very much. And Britt's gonna review everything.
Great. I know we only have 9 minutes before Rich is going to get
Walk
upset. So better hurry. 125.8 million at the end of April. All the asset classes are in line with their targets. Continues to be a slight overweight to domestic equity and PIMCO, and slight underweights to international and fixed income. We show performance on the last page. As you know, the OPEB has a little more equity risk embedded in the portfolio. So you can see slightly more negative returns fiscal year to date, down about 8.3%. As we discussed, PIMCO largely driving the relative underperformance due to some of their equity exposures. But long-term total fund returns and the managers continue to perform as expected. Any questions on OPEB performance?
Nope.
Any questions? Nope. We already discussed management fees
Good.
from,
Yep, I just, for the OPEB fees on page 6 of the fee analysis, I mean, essentially all of the fees are very competitive. Would just note that TCW vehicle, the OPEB is not eligible for that lower vehicle because of the type of plan that the OPEB is. So I just wanted to highlight that. And PIMCO, as we discussed with the pension, slightly above median, but no concerns. And we think their fee is reasonable along with all the other managers.
Hey, Brett, quick question on fee analysis in general. Do other pension funds sometimes, is there an industry-wide comparison of all-in fees for all asset classes, which would, obviously take into account asset allocation differences, but does anybody look at it that way, or is it just all by asset class?
Yeah, we can look at it all in. We used to do a survey that really tried to hone in on total plan fees. So you could have more of a all-in ballpark of how you compare to peers. I'd have to see if, I honestly don't know that we still do it anymore.
No, that's all right. I was just curious.
Yeah, we have in the past, but I think we've found that really getting down to the manager specific level is ultimately what you can control. And the asset allocation is really a completely different decision.
Okay, thanks. That's it.
any other questions?
Nope.
If not, so that I get this done before 8 o'clock, is there a motion for adjournment?
Got 5 minutes. You're good.
Motion
to adjourn.
Seconded.
Second.
All in favor?
Aye.
Aye.
Passes
Excellent.
unanimous. Excellent. Thank you very much.
Have a
Great
great
meeting,
summer,
everybody.
everyone.
Yep.
Have a good summer. See you in
Everybody have a
September.
good summer.
All right. Thanks, everybody. Bye-bye.
All right. Bye now.